Two people, same income, same age, same dream: financial freedom. One of them invests every single month into a mutual fund, the same one their financial advisor recommended in 2019. The other one invests the same amount every single month into a simple ETF they researched on a Sunday afternoon. 20 years later, one of them has $340,000. The other one has $611,000. Same money, same market, same time period. A difference of $271,000. Created entirely by one decision, made once on a Sunday afternoon. Today, we find out which decision that was and why almost nobody makes the right one.
Here is what we are covering today. We are going to follow two people, Nadia and Omar. Same age, same income, same monthly investment amount. The only difference is where they put their money. We are going to break down exactly what an ETF is and what a mutual fund is, in plain language. No jargon, no finance degree required. We are going to look at the 4 specific areas where these two investments diverge: fees, taxes, flexibility, and performance, and run the exact math on what each difference costs you over 10 and 20 years. We are going to look at the real data on why the majority of actively managed mutual funds underperform their benchmark index over any 10-year period. And we are going to show you exactly which one belongs in your portfolio and under what specific conditions. By the end of this video, you will never look at your investment account the same way again. Stay with me, because the fee section alone will make you genuinely angry. My name is Zishan, and welcome to the Wealth Operating System, where we treat personal finance like an engineering problem. Today, we are running a comparison that could be worth hundreds of thousands of dollars to your financial future. Let us get into it.
First, let me introduce you to Nadia and Omar. Both are 28 years old. Nadia lives in Manchester, UK. Omar lives in Austin, Texas. Both earn the equivalent of $55,000 per year. Both have read enough about investing to know they need to start. Both commit to investing $500 per month every single month for the next 20 years. The only question is where. Nadia goes to a financial advisor. The advisor, after a 45-minute meeting filled with charts and terminology, recommends an actively managed mutual fund, a well-known one, solid track record for the last 5 years. A fund where professional managers research stocks, make decisions, buy and sell constantly, all in pursuit of beating the market and delivering superior returns. The expense ratio, the annual fee charged by the fund, is 1.2% per year. Nadia does not think much about the fee. 1.2% sounds small, almost negligible. She signs the paperwork and sets up the automatic monthly contribution. Omar does his own research. He reads, he watches, he spends one Sunday afternoon going down a rabbit hole of investment comparisons. At the end of that Sunday, he opens a brokerage account and puts his $500 per month into a simple S&P 500 ETF, an exchange-traded fund that tracks the entire U.S. stock market automatically. No active management, no stock picking, just the market. The expense ratio? 0.03% per year. Omar does not think much about it either. But the math? The math is already running.
What are these things actually? Before we go further, let me explain exactly what these two investments are. In plain language, no jargon. A mutual fund is a pooled investment vehicle managed by professional fund managers. You give them your money, they combine it with money from thousands of other investors. Then they use that combined pool to buy and sell stocks, bonds, and other assets based on their research, their analysis, and their judgment about what will perform best. You pay them for this service every year, regardless of whether they beat the market or not, regardless of whether you make money or lose it. The fee is charged automatically, silently, as a percentage of your total investment. Most actively managed mutual funds charge between 0.5% and 1.5% per year in fees. An ETF, exchange-traded fund, is fundamentally different in philosophy. Instead of hiring managers to pick stocks, an ETF simply tracks an index. The S&P 500 ETF does not try to beat the market. It is the market. It owns a tiny slice of every company in the S&P 500, automatically, in proportion to their size. When Apple does well, the ETF goes up. When the entire market does well, the ETF goes up. When the market falls, the ETF falls too. No manager, no research team, no stock picking. Just the market, captured automatically at almost zero cost. The most popular S&P 500 ETFs charge between 0.03% and 0.20% per year. Now, those two fee numbers, 1.2% versus 0.03%, look almost identical. They are not. And the math of that difference, over 20 years, is one of the most shocking calculations in personal finance.
The fee that steals your future. This is the section that will make you angry. You have been warned. Let us run the exact numbers on Nadia and Omar. Both invest $500 per month for 20 years. Both achieve the same gross market return, 10% per year average, the historical average of the S&P 500. The only difference is the fee. Nadia, mutual fund, 1.2% annual fee. Her net annual return after the fee, 8.8% per year. After 20 years of $500 per month contributions at 8.8% net return, Nadia's portfolio, approximately $340,000 to $355,000. Omar, ETF, 0.03% annual fee. His net annual return after the fee, 9.97% per year. After 20 years of $500 per month contributions at 9.97% net return, Omar's portfolio, approximately $611,000 to $640,000. Let those numbers sit. Nadia, $347,000. Omar, $620,000. The difference, $273,000. Created entirely by a 1.17% difference in annual fees. Not by market performance, not by investment choices, not by how much they contributed. By a fee that Nadia barely noticed, that sounded like almost nothing, 1.2% when she signed the paperwork. Now here's what makes this truly devastating. Nadia contributed $120,000 over 20 years, $500 per month for 240 months. The mutual fund fee did not just take 1.2% of her contributions. It took 1.2% of her entire growing portfolio every single year. As the portfolio grew larger, the fee grew larger too. In year 1, the fee was small, maybe $80. In year 10, the fee was approximately $1,400. In year 20, the fee was approximately $3,800. Total fees paid over 20 years, approximately $28,000 to $32,000. Nadia paid $28,000 in fees to a fund manager who, as we are about to discover, almost certainly did not beat the market anyway.
The performance problem. Here is the assumption buried inside every mutual fund pitch. The assumption that makes the fee feel justified. The assumption that professional managers, with their research teams, their Bloomberg terminals, their decades of experience, can consistently identify which stocks will outperform the market. And therefore, even after the fee, you end up ahead. It is a reasonable assumption. It is also, according to the data, almost entirely wrong. The S&P Indices versus Active (SPIVA) report is published every year by S&P Global. It tracks the performance of actively managed mutual funds against their benchmark index. Here are the real numbers. Over any one-year period, approximately 51% of actively managed large-cap funds underperform the S&P 500. Over any 5-year period, approximately 79% of actively managed large-cap funds underperform the S&P 500. Over any 10-year period, approximately 85% of actively managed large-cap funds underperform the S&P 500. Over any 20-year period, approximately 92% of actively managed large-cap funds underperform the S&P 500. Read that final number again. Over 20 years.
92% of professional fund managers, with all their research, all their experience, all their resources, fail to beat a simple index. A simple index that requires no manager, no research team, no stock picking, no expensive fees, just the market running automatically, compounding quietly year after year. The longer the time period, the worse active management looks. And this is not a new finding. This data has been consistent for decades. Warren Buffett, arguably the greatest investor alive, has consistently said that for the vast majority of investors, a low-cost index fund will outperform almost any actively managed alternative over a long enough time horizon. He was so confident in this that he made a famous $1 million bet in 2007 that a simple S&P 500 index fund would outperform a portfolio of hedge funds, the most sophisticated active management on Earth, over 10 years. He won by a significant margin. The index fund returned 7.1% per year average. The hedge funds returned 2.2% per year average, after fees.
The tax difference nobody talks about. Here is where it gets even more interesting. The fee is not the only cost advantage ETFs have over mutual funds. There is a tax difference, and it is significant. Here's how it works. When a mutual fund manager buys and sells stocks inside the fund, which they do constantly in pursuit of outperformance, those trades generate capital gains, and those capital gains are passed directly to you, the investor, as a taxable event. Even if you never sold a single share of the mutual fund yourself, even if the fund's overall performance was poor, you can receive a capital gains distribution from a mutual fund in a year when the fund lost money and still owe taxes on it. This is called phantom income, and it is one of the most frustrating and least understood aspects of mutual fund investing. Real example. In 2022, one of the worst years for stock market performance in recent history, several large, actively managed mutual funds distributed significant capital gains to their investors. Investors who had already lost money on paper received tax bills for gains they never actually experienced. ETFs, because of how they are structured, almost never distribute capital gains to investors. The in-kind creation and redemption mechanism allows ETFs to manage their portfolios without triggering taxable events internally. The result? ETF investors generally pay taxes only when they sell their own shares. Mutual fund investors can pay taxes every single year, even in years they did not sell anything, even in years the fund lost money. Over 20 years, this tax difference adds thousands of dollars to the ETF investor's advantage. Nadia, in our example, is paying fees and potentially paying taxes on capital gains distributions she never asked for. Omar, in our example, pays his 0.03% fee and defers all taxes until he actually sells. The system, once again, is designed to extract value from people who do not understand it. The fix, once again, is knowing how it works.
The flexibility factor. There is one more structural difference between ETFs and mutual funds that matters, especially for young professionals who value control over their financial life. Flexibility. Mutual funds, by design, can only be bought and sold once per day, at the end of the trading day, at the closing net asset value price. This means if you decide to invest on a Tuesday morning, your money does not actually enter the market until Tuesday evening, at whatever price the fund closes at. And if you want to sell, for any reason, you wait until end of day. No control over the exact price you receive. ETFs trade like stocks throughout the entire trading day, in real time, at the exact price you see on the screen at the moment you decide to buy or sell. You have complete control over timing. You can use limit orders, specifying the maximum price you are willing to pay. You can buy partial shares on most modern platforms, meaning even $50 gets you into the market immediately. For long-term investors, this flexibility difference is not critical on a day-to-day basis, but it matters for one important reason: control. In a world where financial systems have repeatedly failed the people who trusted them, having maximum control over your own investment at the exact moment you want to act is not a small thing. It is the difference between being a participant in the financial system and being a customer of it.
When do mutual funds actually win? Now, in the interest of complete honesty, because this channel does not have an agenda, let me tell you when mutual funds actually make sense. Situation 1. Workplace retirement plans with limited options. Many 401k plans in the USA and workplace pension schemes in the UK and Europe offer only mutual funds as investment options. In this situation, you choose the lowest cost mutual fund available, typically an index mutual fund, and you contribute anyway. The tax advantages of the 401k or pension wrapper outweigh the mutual fund structure cost. Situation 2. Index mutual funds with very low fees. Not all mutual funds are actively managed. Vanguard and Fidelity both offer index mutual funds with expense ratios as low as 0% to 0.10%. These are essentially identical to ETFs in cost, and in many retirement accounts, they are perfectly appropriate. Situation 3. Automatic investment with no minimums. Some mutual funds allow you to set up completely automatic investments of any amount, any day, without needing to place a trade manually. For people who want complete automation and never want to think about it,
this can be a genuine advantage. The enemy is not mutual funds. The enemy is high fees. Whether you are in a mutual fund or an ETF, the single most important number to look at is the expense ratio. If it is above 0.5%, question it. If it is above 1%, it needs to significantly outperform its benchmark to justify the cost. And based on 20 years of SPIVA data, it almost certainly will not.
So let us bring Nadia and Omar home. Same age, same income, same monthly contribution, same 20 years. Nadia, actively managed mutual fund, 1.2% fee, $347,000. Omar, simple S&P 500 ETF, 0.03% fee, $620,000. The difference, $273,000, was not created by market performance. It was not created by superior stock picking. It was not created by anything dramatic or complicated. It was created by a fee. A fee that sounded like almost nothing, 1.2%, when Nadia signed the paperwork at 28. A fee that compounded over 20 years quietly transferred $273,000 from Nadia's retirement into the pockets of a fund management company that, with 92% probability, did not even beat the market. This is the system. Not malicious, not illegal, just designed very efficiently to extract maximum value from the people who do not understand how it works. Now, you understand how it works. The fix is simple. Check every investment you currently hold. Find the expense ratio. If it is above 0.2%, research a low-cost ETF alternative. If you are in a workplace plan with limited options, choose the lowest cost index fund available. If you are building your own portfolio outside of work, VOO, VTI, VWRL, depending on your country, are your starting points. Simple, boring, incredibly powerful over 20 years. Now, I want to ask you one question. Do you currently know the expense ratio of every investment you hold? Drop your answer in the comments. Because if the answer is no, you might be Nadia right now, without knowing it. And if this video just saved you from a $273,000 mistake, please subscribe. Because every single week we are dropping new system upgrades, built specifically for young professionals in the USA, UK, and Europe, who are serious about keeping every dollar they earn working for them, not for a fund manager. My name is Zishan. This has been the Wealth Operating System, and I will see you in the next upgrade.